Okay, everybody, it's September 19th. It's a Sunday, but we're going to do our Friday investment talk. A little late this week. We got back from Vegas. We were at a conference last week, a little bit behind the curve on Friday. So we decided to take the weekend and regroup. Veronica, you wanted to start with a presentation that Bloomberg Intelligence came out with. It talks about different ETFs to watch this year. And I think, Alan, you're going to go over some stuff about some commodities, natural gas, which is another thing you can get via an ETF. And then I'll try to talk about the market a little bit and some other things that we heard on the floor of the conference in Vegas. So let's get started.
Yeah, we went last week to the conference, investment conference in Las Vegas. It's called Money Show, and it's actually 40 years old this year. And they, during 4 or 5 days, they had 160 different workshops and seminars from family offices, asset managers, investment advisors. It was actually amazing to meet and talk to all of them and see the actual retail investors, what they're interested. So tons of ideas, tons of motivation. And one of the presentation was from Bloomberg. And especially it's interesting to our clients because it talks about ETFs to watch until the end of this year. And it's more than 30 slides, so I will go over maybe 15 major slides quite quickly, so you kind of give you a taste what was there. So they talked about that ETF industry is growing really fast, and the most ETFs that are growing right now that are really, really cheap, like dirt cheap, as you see on the slide here, or the ones that's kind of shiny ETFs, like ARK, for example, ARK Innovation ETF. And we can see on this slide how this ARK Innovation ETF did in white compared to NASDAQ, QQQs, and S&P 500 in green. Also, Bloomberg talked about Bitcoin ETFs. That's a topic that's been going around for many, many years. And still there is no Bitcoin ETF or crypto ETF in the United States. And here's the list of all ETFs that are actually right now under reviews and expected to be approved. Some of them, the earliest, it's in October. So in October, we expect some ETFs to come up. And as you can see, the list, there is ETFs from Kathy Woods that applied for Bitcoin ETFs. There are ETFs from VanEck and
Invesco,
iShares.
yeah.
Like you can see all Goldman Sachs, all major investment houses want to get into this market, of course. Mm-hmm. Also, Bloomberg talked about ETF vote. It gets more and more popular. It's not only its ESG ETF, it's got a different approach to ESG. It's actually where investors want to get an active role in being as a majority shareholders like BlackRock and other companies, where they can influence the companies who's got ESG problems, like even oil companies or gas companies or real estate companies. So this is an active approach through investment to ESG. So please remember this vote. It's getting more and more popular. Uranium ETF. It's the highest performing ETF this year. It's plus 80%. This year, and if you could see on the first slide, it's again number one, 81% this year. So it's still interesting according to Bloomberg. So we're still watching it. Huge inflows. Bloomberg also talked about again, ESG ETFs, not only vote, but another approach to ESG ETFs, not only choosing ESG companies, but choosing ESG markets. Like, for example, Freedom ETF is focused on the markets that are ESG, like it doesn't invest in China, doesn't invest in Russia or Turkey. That's why it's also currently performing better than overall market, broad markets. Now we have some ETFs that were created during the pandemic, like meme, FOMO, buzz. And what we see in currently that a lot of investment houses, investment banks, when they're creating their own ETFs or their own funds or picking the stocks, they're also analyzing the social activities and social impact around on these stocks and around this area. So they're analyzing Reddit and what's going on in social media. So this is some ETFs to follow. Thematic ETFs always been popular, but right now, as you can see on the slide, which themes are the most popular, like innovation, blockchain, we have cannabis and
Clean energy.
healthcare. Yeah, clean energy. VTI, it's actually was interesting point that Bloomberg made. This is the real FOMO ETF. And why is that? Because it's the broadest ETF that covers the entire market. It's like 4,000 companies in this ETF. And if we compare to S&P 500, and the major problem that Bloomberg saw in S&P 500 ETF, that it missed rising Tesla. Because it was just added to S&P 500 at the end of 2020. With this ETF, this is actually, you'll never miss anything out. It's diversified in all categories across US market. So you can see how it compares also to and the Tesla issue. The Tesla issue that I mentioned is the VTI is in white and S&P 500 is in red on this screen. So there we also see tons of COVID-related ETFs, like, and we did talk a lot about them, like Jets and Cruise and Trip. Some of them kind of go up when people traveling more, like for example people were out of healthcare stocks and went into Jets, and Trip now kind of is turning around more into healthcare and less into Jets and Cruise. ETF, China ETF. China has been down, as we all know, quite this year. And the KWEB, China ETF, it's internet companies in China. As you can see, it's 30% down this year, but it's still, in terms of volume, it's the largest ETF, a Chinese ETF, it's 6 billion. So Bloomberg recommends, if you choose China, since China is down so much, choose the one that's internet, focuses on internet companies that's been down so much. Dividends, always interesting. I'm just interesting for our clients. So I'm just gonna go quickly through some ETFs like dividend ETFs. We talked about infrastructure ETF. This is PAVE. There's a lot of what I point during the presentation we've been discussing throughout the year in our Friday investment talks. Inflation ETF, also we discussed this ETF, but right now it's got huge inflow because there is inflation talks everywhere right now, and this ETF's got a huge, great year just because of the talks around inflation. And as we can see, it's mostly in financial services, oil, gas, mining. So basically, that's the major ETFs.
Well, great, Ron. Actually, there was another ETF I remember. I went to a different seminar, and it was by Dimension, which they do different ETFs, and they also launched a bunch of ETFs this year. And one of them was OOTO. It stands for out of the office, and it was another pandemic kind of ETF that they had created. They had the FOMO ETF, and they were talking about some of their other stuff. But OOTO was one that kind of was really kind of cool, and it was things about not going back to the office. So it was all about like Netflix and Zoom and all these other stocks that benefit from staying at home or a partial return to the office. I think my camera went down, but that's okay.
Your camera went down. While you're fixing that, thanks, Veronica. That the Money Show sounds awesome, and I know that's not the first year the ABC have been there. I think that's probably your fourth or fifth year, and I'm certainly intending at some point to make the trip and go there with it, because every year that you guys go, every time that you guys go, you come back with a full suitcase, metaphorical suitcase full of ideas, innovations, and that's great from ABC's point of view. There's a huge amount of resources that we get from that.
Yeah, we signed up for a lot of research too, and it was really cool. I'm going to be sharing some of that later throughout the year with us. So, Alan, you wanted to talk about not far off our topic is some of these high-flying ETFs, some of these commodity ETFs, specifically natural gas, right?
We'll kind of finish at that point. I mean, you'll bring up the natural gas ETF as we look through it, Chris, but what I wanted to focus on really was the commodity price itself. And for viewers that are not, maybe even in Russia, I think probably it's made the news. I can't be sure, but certainly in Europe, and the UK, it's become this last week, it's become headline news pretty much everywhere. So maybe in the US, it's not as sensitive to natural gas prices. So hence, it's more, US is more of a crude oil a sensitive market. But basically, we're seeing a potential coming crisis in natural gas, which is going to come this winter. So natural gas, first of all, hit record prices last week on October price. So the 15th of September, the October price hit 79 megawatts per hour, 79 euros, which is the highest price. That's up 250% since January. And the expectations are that it might hit three figures, meaning more than 100 euros per megawatt hour at some point this winter, because remember, this is still summertime. Prices have been rising over the past few weeks and months, and it's really fueled by, pun intended, by the classic demand and supply push-pull. So we've got, on the demand side, you've got a return to work. So people are using gas for various consumptions, increasing move to decarbonization, especially a reduction in oil and coal. So there's the demand has pushed, but it's also some supply issues. 2020 to 21, the last winter basically was quite a long winter in Europe, and it left storage sites depleted. And one report I read that said it's around 22.9 BCM, that's billion cubic meters, lower than normal, which is sounds a lot, and it certainly is. Inventories are lowest for a decade. Asia is potentially, or Asia is buying up any loose liquid natural gas supplies, which could have been used to alleviate a shortage in Europe. And Russia is limiting flows, especially in the spot price. Now we'll come back onto that, because Russia is a perennial scapegoat in a lot of this, and that's where some of the European politicians' ire has been focused. But if we look a little bit deeper at the reasons for that, they're even seeing energy-intensive industries curbing production. So steel and fertilizer, which use a lot of gas, they've actually curbed their production. So that's obviously going to feed into an inflationary environment, which we've talked about many times before. But most probably, or most possibly, it's the domestic market where there's biggest issues. So not so much on the industrial market, but the domestic market. Retail rates have already risen by about 20% this year, and it's likely to stay higher, go higher through the winter. And that's going to make politically, at any rate, I mean, that's going to cause a lot of pain for low-income families, but it's also going to cause a lot of political pain for the ruling governments throughout Europe, not just in the EU, but throughout Europe. So yeah, as Chris has flicked through some of the graphs there, you can see the percentage, right? This is the Bloomberg one, the black one, Chris. You can see how it's risen. This is based at 100 being, sorry, 0 being last year's
August price.
August price. And basically anything above that is the percentage rise from last August's price. So actually, since last August, it's up more than 350%. So it's a huge increase. And various others. So the year ahead German power, that's kind of a key one, because that's a lot of these are working on long-term futures contracts, not month to month. So, but even that is up more than 125% approximately since 1 year ago. So quite significant increases across the board. If there's another tough winter like last year, then one analyst typically in a kind of the way he termed it, a typical commodities advisor, is that the European supply will be very tight, he said, which translates as being very bad, frankly. So yeah, year ahead futures set a record last week in Germany. Coal prices, so basically you're seeing that maybe other fuels are being used. Britain is actually talking about firing up another coal-fired power station, which had actually shut down to basically alleviate this and to help power the national grid in the UK. Coal prices are up 70% year to date. So if you want to have a look at that, ETF, Chris, you can bring that one up. The other graph that you had there is very interesting, because it shows the red line, which is crude oil, and the black line, which is natural gas, Dutch natural gas. That's kind of one of the main markets or the main places to trade. And you actually see that not many times is the black line crossed the red line. And so actually the natural gas is trading at a premium to crude oil, which is very unusual. These are in dollars, by the way. That's why when I mentioned 79 euros per mega kilowatt hour, then you're showing 100 there, which is the dollar price. Now back to Russia, because as I mentioned before, there's some viewers in Russia might be already aware of this. I think it's making some political news there. So Russia is kind of in the firing line, and according to Financial Times, they said that it had enacted a quiet supply squeeze. Well, what does that mean? We'll find out in a second. Something which many people will be familiar with is NS2. That's Nord Stream 2. This is the pipeline that basically bypasses Ukraine and comes straight to Germany. And it's actually been completed, but it's not had approval, legal approval in Germany to actually start transporting gas through that pipeline. And that can take up to 4 months. So some people are saying, well, Russia is kind of, over the summer, they were kind of maybe not reducing supply, but they were not encouraging oversupply. So to kind of tie in politically with NS2. Now that's potentially correct. Not taking a side on that. But actually what I will say, and what most analysts say in something what I've read, is that will not dampen prices significantly. So it might be a nice way to have a go at Russia and say, well, this is a bit of politics, but it's actually not the main reason. In fact, Alexei Miller, the head of Gazprom, was interviewed last week, and he also said that, look, Gazprom have met all long-term contracts, no taps have been turned off. Main reasons are that EU production or European production has fallen sharply. For example, I looked at UK North Sea gas produced 110 billion cubic meters in 2001 compared to only 35 billion cubic meters last year. So that's 30% or thereabouts of what it was 20 years ago. And actually, from politics on the other side, that this is what the Europeans wanted, because they didn't like lots of long-term contracts with Russia. They wanted to encourage a more, if you pardon the pun, liquid gas market, where spot price was actually dictated by the market. And that's what they pushed for. And Russia's saying, well, that's what you've got now. That's why the prices have gone up by so much. So what are you complaining about? So it's very interesting. There's lots of kind of things at play. And in actual fact that the Europeans are complaining about that. They're obviously competing with Asia. There's the Power of Siberia pipeline, which is now shipping quite a lot of gas to Asia, and Asians are also buying up a lot of liquid natural gas, as we talked about. But what a lot of the Europeans are responding to Alexei Miller by saying that Gazprom refused to supply top-up spot prices over the summer, which what they could have done was basically put more gas on for sale, so oversupplying the market through the summer, which the Europeans would then have used a lower spot price to buy more gas to replenish stocks, which would have helped impact in the winter. So final point, though, interestingly, according to the analysts we spoke to, ABC spoke to, many of the storage facilities not at capacity in Europe were actually run by Gazprom, which is a really curious thing. So it actually seems that Gazprom are refusing to buy from Gazprom and thereby focusing the Europeans to look elsewhere for supply, which are competitors to Gazprom. So it's all a bit strange. Let me finish off by saying, how do you play this? Well, there's a couple of ways to play. There's natural gas ETF, which we've looked at. There's the coal ETF, which I think Chris was looking at bringing up.
That coal ETF's out of business now. They shut it down last year. So I was going to bring up some. There's the
decarbonizing effect of the global economy. The last thing I wanted to pick, I don't know if you can pick this up, Chris, is EXH9. It's a Eurostoxx 600 utilities ETF. I think I've got some information on it on the last slide there, which basically shows that. I mean, it's risen okay, but it's basically flat for the last year. And I think it could be an interesting play. This is one of the, you remember in Europe, ETFs are not that liquid and not that well known as they are in the US. So it's difficult to find a European utilities ETF. This is a European utilities ETF. And we think that could be an interesting way to play it. Yeah, an interesting way to play it. And notwithstanding the fact that, and that brings it right back to the first point I made, which was an inflationary aspect to it, especially on the commodities side. And we were told, and we've discussed this on the FIT before, that utilities are an interesting way to play an inflationary market.
Actually, as I listen to you talk, I'm thinking, okay, this is all just inflation. This is really just an inflation thing where you see the long-term German prices, going up over 100% now since a year ago, and this is going to trickle down, I think, right? It says right here, higher energy prices will start feeding into the bills, so we're going to have to pay.
Yeah, they're already 2025. People, we are even in Hungary. There's a lot of talk about people hurriedly putting in solar panels, basically, and trying to get away from reducing their gas, because actually Hungary is quite dependent on Russian gas, quite dependent on gas. Full stop. And so the solar panels is a way, and the government is basically giving huge grants to private people who want to install it in their houses.
A lot of potential pent-up inflation in commodity prices that we're seeing across not only America but in Europe.
Right,
also.
and it's not just gas. Veronica mentioned uranium. It's interesting because you can't really it's not broad market. And it's not maybe also your typical ones like gold, for example, commodities to play, or even oil.
Right. Okay. So we went a long time and talked about different ETFs today, both kind of ignite investors into attention and enthusiasm, and then some of this kind of more bland stuff like utilities. But at the same time, across the board, we see a lot of interest in ETFs. We've always seen a lot of interest in ETFs. And I just wanted to bring up an article that was in Barron's this week. It's no surprise that some of the big players are going to get in on some more ETF kind of names. They're going to come up with new ETFs. So Goldman Sachs actually is targeting sectors that are typically ruled by Cathie Woods and her ARK stuff. So the genomic stuff, the technology stuff, the AI, the data security. So you're going to see a lot of these companies that we've talked about before show up in new ETFs. So it's not just going to be Cathie Woods anymore. And that's going to maybe put a little pressure on the interest in just the following that Cathie Woods has. So that's an interesting development, I think. We see also inflation in not only natural gas, and I can bring that up real quick, but like we said, there's coal prices went up. Some of these coal companies are way up this year. This is up since April of this year, it's up, 100%. ARKK, it's probably one of the largest coal producers in the United States. I'm not going to go through the data this week because it's kind of off topic. We'll maybe pick it up next week, but we'll go back and talk about inflation, about what's going to happen next week with Jerome Powell, because there's going to be news coming out about that. And just in general, I wanted to highlight that the market has pulled back, and it's, I think, 2 weeks down now in a row. And you can see here it's pulled back last week and this week a little bit, had a rebound, but yesterday's sell-off was pretty substantial. In that usually when you get these pullbacks, and I think it hit the 50-day moving average, I don't have it on here, but everybody expected the S&P 500 to bounce. Well, it really didn't bounce. It actually closed lower than the low of the bounce day on Wednesday. And so really there's kind of fear in this market. I wanted to bring that up just in terms of where we are. There is fear starting to show up in CNN's business index here. Last week we were on a 50 mark with the fear and greed index, and now we're down already at 34 level. So we're headed into this fear level. And if you look at what this is made up of, market momentum shows fear, safe haven demand is showing fear, but some of these things like put call options, market volatility, stock price strength, and stock price breadth are all in extreme fear levels. So I think they're waiting for the junk bond market to roll over, because that's still in extreme greed. And it's moved up. Things have gotten greedy as we see, I think, and it doesn't make sense to me. If interest rates are going to go higher, everybody's pouring their money into junk bonds. It seems like that's set up for a real disappointment if Jerome Powell actually does mention tapering or potentially higher interest rates next year. But I guess maybe the market is saying, look, we don't think Jerome's going to do anything in the short term. We're going to get a good bounce here towards the end of September. So we'll see how that plays out next week. But I just wanted to mention that there are signs that the market is becoming more and more oversold, although I want to just show that some of these levels are not that oversold yet. So if you look at things like NIMO, which is one of the things that make up one of the indicators that make up the fear and greed index, is not oversold yet at all by any means, and actually should go a lot lower before it is oversold. And the percent of stocks above their 20-day moving average is also not oversold yet. We would want to see this get down into the 15 to 20% of the stocks are only above their 20-day moving average before we would initiate a strong bullish signal in the market. So we're waiting for that. The end of September is usually a week period. We'll see how that plays out as we go into the second half here. And just in general, McMillan himself shows that some of these put call ratios are giving mixed signals right now, and it's really hard to read into whether the market's going to sell off strongly or if it's just going to be pullback. But in general, the conclusion is the S&P has been in a slow motion decline for the most of September, for the first 2 weeks, 2.5 weeks here, and they're looking for basically support to hold somewhere around 4,300 level, and that will just be a constructive pullback and will offer buy signals in October. We do have the October calendar that will be published this weekend on our blog, and it does show that there's a lot of bullish days in October, and October is generally known as the bear killer. So it's the time when it says here late October is the time to buy depressed stocks, especially tech and small caps. October ends the worst 6 months in the Nasdaq's worth 4 months of the year. So we're looking at a time in October when we can get long in the market. The bigger the pullback in September and the early parts of October would be better. So we're not just hoping for kind of slow-mo thing, but actually to accelerate and to give us a better chance for a better buy signal. So that's kind of what we're looking for. Pay attention to our blog, pay attention to our Telegram channel, and thanks everyone for joining on Facebook. It's always a pleasure to see you guys on the weekend, and we'll talk next Friday. Bye-bye, guys. Thanks.
Bye, everyone.